The Tax Resolution Institute presents Research and Development Tax Credits by Kevin Zolriasatain and Michael Maroney of KBKG.
Hi, my name is Kevin Zolriasatain and I'm a partner and R&D practice leader for KBKG, and I'm here today with Michael Maroney.
I'm Michael Maroney. I'm a senior manager with KBKG, and I've advised clients on tax matters related to federal and state research and development tax incentives.
KBKG is a specialty tax and consulting firm providing nationwide services. We were established in 1999 and have offices throughout the United States. Our engineers and tax experts have performed thousands of tax projects resulting in hundreds of millions of dollars in benefits for our clients. By focusing exclusively on value-added tax services that complement your traditional tax and accounting team, we always deliver quantifiable benefits to our clients. Listed on this slide are some of the services that we provide. Today we're going to talk a little bit about the Research and Development Tax Credit. We're going to start with looking at the history of the Research and Development Tax Credit and some of the recent changes. We're going to look at the opportunity around Research and Development Tax Credits, talk about some of its benefits, tax treatment, and components. We're going to move on and discuss what qualifies by looking at the four-part test and looking at several of the qualifying and non-qualifying activities. We're going to discuss the different calculation methods and examples, and we're going to wrap up by looking at some of the tax planning and audit consideration. The Research and Development Tax Credit was originally enacted in 1981. At the time, Congress and the President saw an exodus of manufacturing jobs outside of the U.S. and wanted to incentivize companies to keep certain types of jobs in the United States. And so Congress enacted the Section 41 credit for increasing research activities. At the time, it was a temporary code section and stayed as such until the Protecting Americans from Tax Hikes Act of 2015 made it permanent. Prior to it becoming permanent, it had expired 16 different times. It is both a federal and state incentive. Every year there are billions of dollars handed out in tax incentives to different types of companies and across several industries. And it is a proven fact that it helps stimulate economic development in the United States. One of the big changes that occurred as a result of the Protecting Americans from Tax Hikes Act of 2015 was now a company can use the Research and Development Tax Credit to offset payroll taxes. Prior to the PATH Act, companies that were in losses or startup companies could not use research credits to offset any portion of their tax liability. As a result of the PATH Act, which is applicable for tax years beginning after December 31st, 2015, qualified startups can now use up to $250,000 of research and development tax credits to offset their payroll taxes. A qualified startup is defined as a company that has gross receipts of less than $5 million and has gross receipts for less than 5 years. If the first-year election is made in 2020, a company could not have had gross receipts prior to 2016. So if the election is made in 2020, the company could have had gross receipts in 2020, 2019, 2018, 2017, and 2016, but nothing prior to that. Additionally, we must ensure that the company has gross receipts of less than $5 million in that year of election. The election cannot be made for more than 5 years. Gross receipts are not required, so pre-revenue companies or companies that are in the pure startup phases can still qualify for this. The election starts the first quarter after which the election is made. And so if a company is filing their 2020 tax return in March of 2021, the payroll tax portion of this would be applicable the second quarter of 2021. Good candidates for this include software and biotech companies, basically companies that have long lead times to product development or long lead times in product development, companies that are going to take a while in order to see any kind of revenue resulting from their research and development activities. In this slide, we have an example of the application of the payroll tax portion of the PATH Act. A software developer that began operations in 2016 has 15 individuals and is not expecting gross receipts until 2018. So here's a summary of the financials. The company has 0 gross receipts, so they're pre-revenue. Qualifying wages of $2 million, so the resulting R&D tax credits are $200,000. The qualified payroll taxes for them are $125,000. So this company will be able to use up to $125,000 of research and development tax credits in that year. Prior to the PATH Act, this company would have had to carry forward $200,000 of research and development tax credits. Subsequent to the PATH Act, they can now use $125,000 of those credits and carry forward the remaining $75,000 to subsequent periods. The second big change as a result of the PATH Act had to do with alternative minimum tax. Prior to the PATH Act, research and development tax credits could not offset any portion of an AMT liability. And so companies that were in AMT would have to carry those credits forward until they had ordinary income tax to offset. Subsequent to the PATH Act, eligible small businesses can now use a portion of their research and development tax credits to offset their AMT tax liability. This also is applicable for tax years beginning after December 31st, 2015. An eligible small business is defined as having an average of $50 million or less in gross receipts in the prior 3-year period. It's important to note that it's the average that we're talking about. So if in any one year they have more than $50 million, it's important to look at the average and not simply that 1 year. The provision is similar to the AMT relief from 2010. Any unused credits can still be carried back or forward. The one caveat to this is that the company cannot be a publicly traded company. This slide has an example of the AMT provision prior to 2015. So this is pre-PATH Act and how it's applied. So in this example, the company generated 2015 R&D tax credits of $300,000. They have $181,000 in tax liability, which is comprised of $158,000 in regular tax liability and $23,000 of AMT liability. This company cannot use any of the research and development tax credit for 2015. They're forced to carry forward the entirety of that $300,000 until they have ordinary income tax liability to offset. What this slide illustrates is a post-PATH Act environment. This company has generated $331,000 in research and development tax credits. They have a total tax liability of $219,000, which is comprised of $188,000 in regular tax liabilities and $31,000 in AMT liabilities. For tax year beginning after December 31st, 2015, this company can now utilize up to $178,000 of the research and development tax credits to offset a portion of their AMT and regular tax liability. Prior to the PATH Act, this company would have had to carry forward $331,000 in research and development tax credits. But due to the PATH Act, this company can now use a large portion of their R&D tax credits to offset their tax liabilities. They will be carrying forward the remaining difference. And now I'm going to pass it back to Michael to talk a little bit about the opportunity around R&D tax credits.
The Section 41 credit is a general business credit. As such, it provides a dollar-for-dollar reduction in a taxpayer's income tax liability. For pass-through entities such as S-corps or partnerships, they can also claim the credit. Benefits will flow through to the individual shareholders on each shareholder's respective K-1s. Unused credits can be carried back 1 year and forward for up to 20 years for federal purposes. This chart represents the total amount of federal R&D credits claimed since 2005. It's estimated that nearly $15 billion of R&D credits will be claimed by companies in 2016. Now, this chart represents the size of the businesses that are claiming the federal R&D credit. Roughly 87% of companies that currently claim the credit have revenue in excess of $100 million, while the remaining 13% is split evenly between those with revenues of less than $100 million and less than $10 million, respectively. Currently, there's no cap on the amount of the credit at the federal level, so I encourage you that if you have a client who can benefit from R&D credits, to make sure they are aware. With changes resulting from the PATH Act, as Kevin mentioned, I anticipate that small and mid-sized companies we're going to be claiming a larger portion of this credit going forward. It's a great time to revisit this with your clients. The federal R&D tax credit currently offers roughly 6.5 cents for every dollar spent on R&D activities. In addition to the federal credit, many states also offer an R&D tax incentive as well, mostly for R&D taking place within that state. These on the slide are only a few examples. The methodologies may vary, but most follow the federal calculation with variations on the credit rates, the refundable nature of the credit, as well as any carry forward and carry back provisions. As of this year, these are the states that currently offer an R&D credit. Most of these offer a credit on the same qualified expenses claimed for the federal credit and may be claimed in addition to the federal credit. If you or your clients are conducting R&D within these states, make sure you're looking into this valuable benefit. R&D credits can be found in several industries. Here's a list of just some of the industries where research credits can be identified. Basically, if your client is developing something new or improving an existing product or process, it doesn't matter the industry. They are conducting R&D activities eligible for the credit. This slide shows the most popular industries whose companies are claiming the federal R&D credit. It's probably no surprise that manufacturing leads the pack, followed by software developers and engineering and scientific services. If your clients fall within any of these industries, there may be a great benefit here. Now here's a short list of some of the studies we've conducted. Whether it's formulating new organic foods, spices, beer, or wine, experimenting with new ingredients and new processes or techniques may qualify. Whether it's designing and testing new prototype products or experimenting with new processing techniques to gain a competitive advantage, activities can qualify. Whether it's developing software for back office applications, video games, mobile applications, or computer animation, it can qualify. Whether it's a defense contractor developing parts for systems on a ship, plane, or vehicle, it can also qualify. If it's a pharmaceutical company developing drug formulations or conducting testing for humans or animals, it can qualify. Whether it's developing innovative extraction techniques or delivery processes for the mining, oil, and gas industries, it can also qualify. And now I'm going to turn it over to Kevin, who's going to talk about specifically who and what qualifies for the R&D credit.
Okay, great. Thanks, Michael. And now we're going to talk a little bit about how to qualify for the Research and Development Tax Credit. It generally starts with the identification of a business component. A business component is defined as either a product, a process, a software, or a formula. So what we do is we identify a business component and we apply the qualification criteria to each business component. The first test for the qualification of that business component is called permitted purpose. Permitted purpose has to do with the objective behind the activity. The objective must be to improve the functionality, performance, reliability, or quality of that business component. You cannot have an existing business component, make some small modifications to it, and have it meet this first objective. There must be some material improvement in either functionality, performance, reliability, or quality in order for that first test to be met. The second test is called elimination of uncertainty. And what that tells us is that at the outset of the project, at the very beginning, there must be a degree of uncertainty surrounding it. It can't be something that you know exactly how to do. The uncertainty can be with respect to technical ability, meaning are you setting out to do something that's never been done before? You're going to be the first company to ever do it. It can be with respect to capability, meaning maybe other companies have done it, but you've never done it and you're not sure if you can do it. It can be with respect to methodology, meaning oftentimes there's more than one right way of doing something. Or it can be with respect to appropriate design, which is really working backwards. You start with knowing what the objectives are that you'd like to meet, and you consider different alternatives in design that will help you achieve those objectives. And that leads us to the third test, which is called process of experimentation. That really goes hand in hand with uncertainty. After you've identified your uncertainties at the outset, you're naturally going to come up with alternatives to help you overcome those uncertainties. The only way of identifying which alternative is appropriate is through experimentation. You would need to evaluate each alternative through experimentation in order to determine which one you'd like to continue on with. While you're conducting that experimentation, the results of which can either be nailing it, meaning you've got it exactly right and you're going to continue with it, scrapping it because it doesn't work at all, referring to the alternative, or going back to the drawing board and making some modifications to it because it kind of works but still needs some tinkering with. The last test is called technological in nature. And what this tells us is that the activity must fundamentally rely on science. Qualifying sciences are biological science, computer science, physical science, or engineering. So to the extent a business component meets all four parts of that test, we're able to capture the different expenses associated with it towards a research credit. Generally, there are three types of expenses that we qualify. Usually the largest component of qualifying research are wages, and those are for the individuals that are either directly working on, supporting, or supervising qualifying research projects. Number two are supplies, and these are items that are used or consumed in the process. So, for example, any materials used in the development of prototypes would qualify. What is generally excluded out of this category would be any items that are capital in nature. So no land, no machinery or equipment, no property, nothing that has a useful life of greater than that project. The key words having to do with supplies are used and consumed. They must be used and consumed during that project in order to qualify. The third category is contract research, and we're able to capture 65% of the amounts paid to contractors. So to the extent that you are using any third parties in the qualifying research, those payments can also be qualified with the caveat that those payments must be made to companies within the United States. Any outsourcing to companies outside the United States would not qualify for the research and development tax credit. So if you have a company that's working on qualifying research in the United States and they outsource a portion of that development outside the United States, only the portion within the United States would qualify for the research and development tax credit. Generally speaking, there are three levels of activities that qualify for the R&D credit. The primary level would be anybody that is directly working on the project. So, for example, an engineer that comes to work every day and does nothing but work on R&D projects, that person would clearly qualify for the credit. From there, we're able to capture one level directly above and one level directly below that person. So if that engineer is reporting to a VP of engineering, that person's time spent supervising the engineer would qualify for the R&D credit. Also, if the engineer has someone that is directly supporting them, so for example, a research assistant that's taking notes, a quality assurance person that's testing prototypes, those people can also qualify for the R&D tax credit. What is excluded would be two steps removed from that engineer. So if there is an engineer that's reporting to a VP of engineering and the VP of engineering is reporting to the CTO in this instance would be 2 steps removed and would not qualify for the R&D credit. This slide has some examples of direct supervision and direct support. So first line supervisors is what we talked about. 2 steps being removed would not qualify in this example. Examples of direct supervision would be attending technical meetings, reviewing technical designs, providing general guidance to the people working on the project, communicating requirements, identifying specifications. Those are all great examples of direct supervision. Below that, you'll see examples of direct support, such as documenting results, maintaining and cleaning research equipment, compiling research data, and creating experimental models. Generally, we're able to capture everything from concept development all the way to the point where a product is ready to be commercially released. Anything after that point would no longer qualify. So anything that's prior to that can be qualified. You are able to apply the shrink back rule, and what the shrink back rule tells us is that you're able to look at the project in whole or break it down into components and apply the qualification criteria to those components. So, for example, if you're building a ship, you can apply the qualification criteria to the entirety of that development, so the entire ship, or you can look at different components that are included as part of that. So the electrical, the sanitation, weapons, anything associated with building that ship, you could look at individually or together as a whole. It's also important to note that success is not required. So to the extent that you are not able to complete the project, you can still qualify for the research credit. You don't have to commercialize the development in order for it to qualify for the R&D tax credit. Non-qualifying activities include any activities that are conducted outside of the United States. It is a domestic credit, and therefore the activities must take place in the United States in order to qualify for the research credit. No adaptation of an existing business component, so no modification of an existing business component is what that's telling us. And if you go back to the 4-part test, we're essentially saying here that that would not meet the first part, which is permitted purpose, making some small modifications to an existing business component. No duplication of an existing business component, so no reverse engineering would qualify. Nothing having to do with the social sciences, no routine data collection, no routine or ordinary QA testing. And also, it's important to note that funded research would also be excluded from qualification. So to the extent that a development is funded by a third party, meaning they retain the rights to it or they incur the risk of the development, those activities would also not qualify for the R&D tax credit. As we said earlier, we're able to capture everything from concept development all the way to the point where a product is ready to be commercially released. This slide has a list of some of the activities that take place after a product is ready to be commercially released. So no pre-production planning, no tooling up for production, no trial production run, no troubleshooting, no accumulating data that has to do with the production process, and no debugging flaws in a business component. And where we oftentimes see that is with software development. After a product is released to the public and it has set functionality and it's not performing one of the functions that it was intended to perform, if it comes back and requires some additional modification, that would potentially be considered bug fixing and therefore may not qualify for the R&D credit. So it's important to note and it's important to review each business component and make that determination. And with that, I'm going to pass it back to Michael, who's going to look at one of the calculation methods and examples. Michael?
All right, thanks, Kevin. We're going to talk now about the calculation methods and walk through a couple of examples. So the credit is the sum of 20% of the company's qualified research expenses, or QREs, over a base amount, plus 20% of basic research payments. These are payments that are made to tax-exempt organizations that perform research on your behalf. Think like universities, scientific research organizations, etc. Plus 20% of payments made to an energy research consortia. Now, these are also tax-exempt organizations who perform energy research. Typically, they're funded by a small group of taxpayers with an interest in the results of the research. Now, the credit is based on the qualifying activities conducted by the company or those performing research on its behalf. This is primarily a wage-based credit. The U.S. Treasury reports that on average, between 75 and 80% of the credit is generated by qualifying wages of its employees. The credit is incremental in nature, which means that you get more of a benefit the more that you spend on R&D year over year. But as we'll discuss shortly with the alternative simplified credit method, that has helped somewhat for companies who are experiencing flat R&D spending or even slightly decreasing R&D spending year over year. There are two federal calculation methods available, the regular credit or the alternative simplified credit. Both methods require calculating a base amount which a company's current R&D expenses must exceed in order to claim the credit at the federal level. For the regular credit, this base period focuses on years 1984 to 1988. Alternatively, if the company was not around during this time or was not spending money on R&D at that time, the base period consists of activities occurring after 1993. For the alternative simplified credit, the base amount involves only the 3 prior years' expenses. Taxpayers may elect on an originally filed return which method it wants to follow. Once made, however, the company is stuck with that election for that tax year. If taxpayers wish to change its election method for a future tax year, it must be made on that year's original return. Now, when amending a prior return in order to claim the R&D credit, either method may be used. Now, for the regular credit method, there are 4 items necessary to calculate the credit. The first is the qualified research expenses, or QREs. The average annual gross receipts for the 4 prior years is the second item that you'll need to calculate. The third item is to calculate the fixed base percentage. Now, this is defined as the ratio of aggregate QREs over aggregate gross receipts for a specific period of time. The maximum fixed base percentage allowed is 16%. The final item you need is to determine the base amount. Now, to do this, you compare 2 numbers. The first, you multiply your average annual gross receipts by your fixed base percentage. Then you take 50% of your current year QREs. Whichever number is greater becomes your base amount. This is the amount that your current R&D spending must exceed in order to get a credit. And then the credit rate is applied to this amount to arrive at your credit. This slide shows an illustration of a fixed base percentage calculation. Now, this assumes a base period in the years 1984 to 1988. This means that the company was conducting research activities in at least 3 of the 5 years during this time period. Now, to calculate the fixed base percentage, we total up the QREs for these 5 years and divide by the total gross receipts for the same period. For members of a controlled group, QREs and gross receipts for each member must be included in this calculation. In our example, you'll see the fixed base percentage is 2.3%. So here's a regular credit calculation example. In this example, we have a company with a current year R&D spend of $3 million. The average annual gross receipts for the 4 prior years is $75 million. We next compare the tentative base amount to the minimum base amount. The tentative base amount is $1.7 million, which is $75 million times the fixed base percentage of 2.3%. Comparing this to the minimum base amount, which is the $3 million in QREs times 50%, we see that the tentative base amount is larger. Therefore, we use that as our base amount. Subtracting the base amount from our current year R&D spending yields $1.2 million in incremental R&D spending. We multiply this by the 20% credit rate to get the gross R&D credit, and again by 65% if the 280C reduced credit is elected. Now, the gross credit must be claimed on an amended return if the 280C election was not made on that year's original return. If the gross credit is claimed on either an original or an amended return, you must reduce the amount of the company's deductible expenses by the amount of the gross credit. To avoid this, it's generally advantageous for companies to elect on an original return the 280C reduced credit, which reduces the credit by 35%, but requires no adjustments to be made to the deductible expenses. This eases the administrative burden in satisfying the general rule that a credit and deduction cannot be claimed on the same R&D expense. And it also provides a lower starting point for taxable income when computing your state taxes. Now I'm going to turn it back to Kevin to talk a little bit about the other method, the alternative simplified credit method.
Now let's look at the alternative simplified credit, or ASC. Recent law changes allow companies to amend returns to claim the ASC. It's a simpler calculation requiring much less historical documentation. The ASC is calculated by applying a 14% credit rate to the current year QREs that exceed a base amount. If a company has no QREs in any one of the previous 3 years, the credit is 6% of the current year QREs. Companies that could benefit from the ASC method include older companies which may not have records to support their base period and fixed base percentage, companies with larger gross receipts. The larger your gross receipts, the larger your base amount, which means the smaller your credit under the regular credit method. Companies with several subsidiaries that may have trouble establishing a fixed base period percentage. The ASC is a great option for these types of companies. There are only 2 items that are needed in order to calculate your credit using the alternative simplified method. Number 1 are QREs, and these were defined earlier in the presentation as wages, supplies, or contract research for qualifying business components. And number 2 is the base amount, which is 50% of the average QREs for the previous 3 years. In this example, we have a company with current year QREs of $3 million. Their base amount is $1.1 million, which is the average of the previous 3 years divided by 2. That leaves us with a creditable amount of $1.8 million. The ASC rate, as we stated, was 14%, and therefore, using this method, their credit is $262,000, so 14% of $1.8 million. They can also elect to use a 280C election on a timely filed return, reducing their credit to $170,000, which results in an effective credit rate of 5.69%. Here are some industry examples where you can see the materiality of the research and development tax credit across several industries, beginning with software development. In this example, a software development company creates software for a game that can be sold or leased to third parties. Therefore, it's not considered internal use software. There is revenue coming in from the development. This particular company has $3 million in gross receipts, total wage expenses of $1 million, the qualifying portion of which is $500,000. It was primarily comprised of software developers and therefore very technical. The qualifying activities include concept development, specification design, coding, and beta testing. The potential federal credit for this company is $50,000, and that does not include any state credits, which could potentially drive up the credits further. This next example is a manufacturing company that designs, manufactures, and tests first article prototypes for a variety of industries. So they're contract manufacturers. This particular company has gross receipts of $7 million, total wage expense of $3 million, and the qualifying wages for this company are $800,000. Qualifying activities include concept development, specification design, evaluating alternatives, prototype testing, prototype refinement. There would also be qualifying supplies potentially included as part of this calculation that were excluded for this example. The potential federal credit for this company would be $80,000, and again, that is not including any state credits that could potentially increase these credits further. And lastly, food manufacturing is a great example of R&D, and one where you would maybe not oftentimes think that there would be much of an opportunity. A food manufacturer formulates and packages a variety of all-natural and organic trail mixes and salad toppings. In this example, this particular client had $6 million in gross receipts and $2 million in total wage expense. Qualifying wages for this company was about $600,000. The qualifying activities included concept development, specification design, evaluating alternatives, prototype testing, and prototype refinement. This company could also potentially qualify supplies that were not included as part of this example. Potential federal credit for this company was $60,000 and again does not include any state benefits. And with that, I'm going to hand it back to Michael so he can wrap this up. Michael?
Thanks, Kevin. We're going to talk a little bit now about some tax planning items. As I had mentioned earlier, electing 280C on a timely filed return can be a good benefit for your clients. What it means is that you do not have to reduce the R&D expenses that you're claiming by the amount of the credit. Also, if your client is a flow-through entity and not in the highest tax bracket, or if they are in a net operating loss, you may not want to elect the 280C reduced credit. If your company is in a loss, you can amend more than 3 years of returns. The Revenue Ruling 1982-49, the way that would work is that you would go back and actually claim the credits for those years, adjust your carry forward credit amounts forward to a future tax year or an open tax year to offset your tax liability. In addition to that, if you're a qualified startup beginning in 2016, a small company can offset a portion of its payroll taxes, up to $250,000. Regarding AMT, starting again in 2016, eligible small businesses can apply the R&D credits against AMT. Also, if you're expecting, you or your clients are expecting a sharp increase in income, you should consider claiming the credit and then carrying those forward to offset future tax liabilities. And finally, companies that take bonus depreciation may want to scale back deductions in order to take advantage of the R&D credit. All right, this next slide shows some IRS audit considerations. I want to point out that there is an audit technique guide out there that outlines the areas that the agents focus on when they conduct their audits for R&D credit claims. The second item on here, the IRS continues to target the use of estimates, even though the courts have ruled time and again that credible estimates may be used to determine qualified expenses, not only in the credit year, but to help substantiate their base years. Also, oral testimony, so long as it is credible, may be relied upon to determine qualified activities surrounding its business components. And then finally, documentation supporting the R&D activities, as well as the expenses related to the development, continue to be a major focus of the audits. Although there's no clear guidance as to what constitutes sufficient contemporaneous documentation, other than permanent books and records sufficient to establish the amount of the credit, the more relevant documentation, the better. This final slide shows examples of contemporaneous documentation. There must be a nexus between qualified projects and qualified activity. So high qualifying individuals should have more documentation as evidence of their involvement on the projects on which they work. So this shows 3 different stages of development: the concept generation and design stage, the testing stage, and then finally the recording or documenting the results phase with sample documentation for each. All All right, and with that, that concludes our presentation for R&D credits. If you have any questions from the presentation today, feel free to reach out to either Kevin or myself, and we'd be happy to discuss your individual situation with you. Thank you.
Thank you.
Thank you for watching. Please look for more programs from the Tax Resolution Institute.